Hello, my name is Steve Matson. I'm with Mile High Mortgage Taylor. Today we're going to talk about a really important topic, long-term interest rates. Specifically, we're going to talk about the 10-year Treasury and how it impacts mortgage rates here in Colorado and across the U.S. We'll also briefly touch on why interest rates have risen since the COVID pandemic. So if you're curious, please tune in. So understanding the 10-year Treasury. The 10-year Treasury note, this is a benchmark for long-term interest rates. It represents the yield investors demand to lend to the U.S. government over a 10-year term. What you'll see here above is the long-term trend downward with the 10-year Treasury. This is going back to the 1980s. This is called the secular decline. There's multiple factors that impact the 10-year Treasury yield. What you'll see here is four of the main impacts. One is economic growth. So a strong economy often leads to higher rates. Inflation, which we've seen during the COVID pandemic. Higher inflation erodes future returns. So during high inflation, usually rates rise as well. Federal Reserve policy has a big impact on interest rates. So things like buyback programs or control over their short-term discount rates. So that has a big impact on long-term interest rates. Also, geopolitical events, things like instability in the market may lead corporations and individuals to flee to lower risk securities such as treasuries. So how do 10-year treasuries impact mortgage rates? So while 10-year treasuries are an important component of a mortgage rate, they are not directly correlated 100% to the mortgage rate specifically. What I'm going to list here on the screen is all the different components that go into a mortgage rate. One is long-term treasuries, but in addition to long-term treasuries, there's additional factors. So those additional factors you'll see in the pie chart, they include the long-term treasuries, they include lender margins, they include credit risk premiums, they include service costs, and they include prepayment risks. So when the 10-year Treasury goes up, you'll generally see mortgage rates follow, although an exact increase, and it's not 100% correlation when treasuries increase, that mortgage rates will increase, but it's highly correlated. So I want to talk to you also why rates went up since the COVID. In the initial response to the economic slowdown, it was unprecedented time. The Federal Reserve cut the discount rate to zero. They started stimulating the borrowing. They started sending stimulus checks. This led to historically low mortgage rates. People were getting new home loans and refinancing under 3%. And then as we started getting out of the pandemic, there was a surge of demand and there was supply chain issues and supply chain constraints that led to inflationary pressures. That with the pressure or the impacts of the Federal Reserve's initial response to COVID, where they cut rates and started stimulating borrowing, this led to inflation. So the Federal Reserve started increasing short-term interest rates, which directly impacted long-term interest rates like the 10-year Treasury. And this and also, of course, impacted mortgage rates. And then as we got further out, the Federal Reserve increased short-term interest rates, and then we had relatively good economic data with the inflationary pressures, which made it difficult to cut short-term rates. As you know, the Fed did have rate cuts last year, and then we're looking at potentially some coming up here in September. It's also important to note that during or since the COVID pandemic, things that go into mortgage rates were impacted, such as lender margins and credit risk premiums went up, which directly impacted mortgage rates, which will likely come down to normal levels coming forward. So not only did long-term treasuries go up, but other factors that go into mortgage rates. So that's a look on long-term trends and interest rates, the important role of 10-year treasury, the comparison of mortgage rates, and the quick explanation of why rates have increased since COVID. So I hope you learned something today. If you have any questions, please comment below. Thanks for tuning in, and let's get you home.